Hi guys, David Jennings here from metaformula.com. Extremely honoured and lucky today to be interviewing one of my personal mentors. Watched Daryl's stuff for a very long time. If you don't know who Daryl Guppy is, you must be hiding under a rock. If you check out his bio page, it's unbelievable. He's written, so many books. I think the latest one, 36
strategies for the Chinese for financial traders.
That's the most recent one, and I love also there's trend trading, there's share trading, bear trading, so many different books. He's a contributor in numerous trade journals. He's a regular contributor to CNBC in China, is it?
It comes out of Singapore, but it goes globally through to the US and Europe as well.
Yeah. So suffice to say, Daryl really knows his stuff, and we're very lucky to grab him. He's actually in Melbourne just for a short time for the Traders Expo, and thought I'd take the opportunity and see if I could get some questions answered for you guys. So thank you for joining us.
No problems.
I'll dive straight in, Daryl. I suppose one thing that I'm trying to work with helping traders achieve is designing a trading system that really matches their style. But a lot of people are sort of finding the stumbling block in that they still don't know what a complete system looks like. So perhaps if, I know you trade using various strategies, but if we were to just sort of isolate maybe one of the trading systems that you use, and if we could talk through the process of, what makes up this trading system. So maybe starting with the market, maybe we start picking a market and go from there.
Well, that's always the important point. What you do is you pick the sort of opportunity, because all of us are accustomed or comfortable with particular types of opportunity. That might mean that you're happier to be an intraday trader or a short-term trader or a breakout trader or a trend trader or a position trader that you want to join in anticipation of the market changing or after the market's changed. So you've got to identify where you're comfortable for a start. Because that's the important point. It's not finding a system or designing a system. What's important is that you have to create an approach that's appropriate for the current market conditions. So if you're trying to use what you used in 2006 or 2007 now, you won't have any success. If you try and use what you used in 2008, applying that now, it won't have any success. Some of it will succeed, but most of it won't. So there's always a challenge to adapt and adjust your trading style and approaches to suit the market conditions. And the big thing that came out of 2008 was a significant change in the nature and the character of the market. The market's become much, much more volatile. We still have what we call an underlying secular trend, so it's still going up broadly or down broadly, but there are lots of what we call volatility wipes. So you'll get days where the market will move 3 or 4 or 5 or 10%.
Yeah,
go back to 2006. The Dow did a 3% rise. It was all over the front page of the newspaper. It was massive headlines, and we all sat back in shock. 3% now? Oh, well, that's not particularly important.
Yeah.
So these are giving us massive wipes in trend trades, in breakout trades. So you have to adjust what you're doing to what the market is telling you must do. Now, there are times when you will not be able to trade that market, where your particular comfort zone isn't anywhere near what the market's doing.
Yeah.
It's a good time to take a holiday. But when the market comes back and gives you the sorts of opportunities that you can take advantage of, that's the time to come back in.
I think the hard thing that a lot of traders have is identifying, okay, well, the market's changed, and they've read all the books and they hear you need to have a trading plan, you need to be following your trading plan, and when you're at a point of indecision, that's when you revert back to your trading plan. How can you build something into your trading plan that allows for change? Because you want to follow your rules, but okay, the market conditions have changed.
The rules are independent of the market conditions. So the rules are relatively simple, and that is that you don't lose money. If you're going to lose money, you lose a very small amount. So that's the basic ground plan. What you do on top of that's another question, and that's where all the different techniques and processes come in. But the market has this really simple scorebook.
Yeah.
If you're in touch with the market, if what you're doing is consistent with the market, you make money.
Yeah.
If you're not, you lose money. And that's when you tell how the market's changing, because you use a technique that has been successful, and suddenly you find that instead of going from a 70% success rate, it drops down to 50% or 30%, so that you're taking more trades, but less of them are being successful. That tells you that the market conditions have changed. If you assume that your analysis is correct, that your explorations are correct, you're turning up the right sorts of opportunities, the material that's worked in the past, that stops working, that's a change in the market, not necessarily a change in you. And there's one very important exception to that, and that is that if you have been through a traumatic event, okay, now It may be a loss of a family member or something similar. In my case, it was having my office wiped out by a flood in 1998. Car accident, something like that. What it does is it changes your relationship with risk.
Once bitten, twice shy kind
That's
of
right.
thing.
And when you come to the market, even though it's not related to the market, when you come to the market, the levels of risk and the type of risk that you were comfortable in handling, you may find that you can't handle. So you're still using the same methods. There's nothing wrong with the methods, the analysis and the techniques, but the way in which you react to risk, the way in which you act on your stops, before your stops often, that will change the results.
I suppose then, having those sets of rules and you're following it, okay, you're starting to see your trading system might dip, okay, we need to change our rules. The other thing as well, let's say having excellent money management in place, you can sustain a string of losses. Let's say, I don't know if you do much back testing or anything like that, or you look back to previously what you've been trading. At what point do you go, okay, well, I've now had 7 losses in a row or 10 losses in a row? At what point do you pull the pin and go, right, this strategy's changed and it's not just part of the normal market aberration and, that's just part of trading, losing?
It's difficult to say, and that depends to some extent on experience. So there's no hard rule that says 7.5 failures, that's enough, I've got to change my system. You're looking at the way that market conditions are changing, and that includes things like volatility, includes trend persistence and trend continuity. It looks at the impacts of other factors, other instruments that are coming in, whether that's tucking speculative money out of particular secular trading. So, for instance, you go back 5-6 years, most of the speculative money was sitting in warrants. That market's now dead. That speculative money has shifted to CFDs. So you can still apply the same techniques in trading warrants, but they will not be as successful because your range of choices is more limited and the market reacts differently because of the lower liquidity. But you can't take the methods you use in trading warrants, because of the time decay factor, for instance, and transfer those to CFDs because they're a different instrument, a different set of behaviours. So trading is a whole combination of different features, and as I said, it does give us an easy way to assess whether we're succeeding or failing. We either make money or we lose money. When do we make that change? That depends again on your own feelings about the strength of what you're doing. So our core methods remain the same over years. It's like a toolbox. If you take a toolbox, you can use the same toolbox to work on a motorbike, on a bicycle, on a car, or on a truck. You've got to work out in the market whether it's a car or a truck or a bicycle. And select the appropriate tools from your tool set. So you don't want to try and develop new skills. That's probably relatively difficult, and there's a limited range of skills that can be developed. What's important is the application of those particular sets of skills.